And I'm John Parker. I'm president of Kennedy Associates, which is part of the Bentall Kennedy affiliated companies. We're investment advisory firms, Bentall and Kennedy, Bentall being Canada, Kennedy being United States. We work very closely together. I'm domiciled in Seattle, Washington. I think probably you should split that into two different types of investor: the private capital or the high net worth investor, and in that sense, the foreign government entities that invest in the United States versus institutional capital, which could be large insurance company related or other aggregations of capital. They tend to be very conservative. And I just returned from a trip to Europe where we talked with two of the larger groups of capital, one in Amsterdam, excuse me, and then also in Zurich. And they're very conservative, and they're concerned about the status of the United States economy, and they're holding back a bit in terms of their investment to see if in fact the market has bottomed. Our own opinion is that you can't call it that closely, and we're somewhere near the bottom, and we think they ought to be investing and taking advantage of the relatively attractive valuations in the United States today versus wait any further. That's probably a 2012 or beyond time frame. We're slowly coming out of this recovery, and it's the pace of that improvement, that, if you want to call it that is a debate. Some people, today's conference, for instance, there was discussions about a very slow recovery, which would imply that we're going to have some level of chronic unemployment for maybe 3 or 5 years even. That's not a very popular perspective, because but nonetheless, it's under consideration as a consequence with sort of the lethargy with which we're moving out of the current economic recession. So at the earliest 2012, and I don't see it coming any quicker than that. It's just a matter of how quickly will we fully rebound, and what are you using as the benchmark to say we're back? That goes into a discussion about primary versus secondary markets. As you get the institutional capital reinvesting in real estate to a meaningful degree, most of the big institutions were severely affected by this depression, recession, whatever you want to call it, over the last 3 to 5 years. Well, 08, 09. And so they're very slow to go back and take a significant risk posture. So what are they looking for? They're looking for the bigger markets, where you've got the greatest concentration of institutional quality real estate. So that means New York, Washington, D.C., San Francisco, Los Angeles to some degree. It's those markets that are also attractive to the foreign capital, that tend to like to be in the Boston, Washington, D.C., New York. As I said, it's the coastal markets, San Francisco, and then their secondary markets are not as large markets. Seattle is certainly an attractive market for the domestic investor. Those will come back because the capital will come back, because they'll perceive those to be the safest markets in terms of the demand-supply relationships, and where institutional investors will put their capital. So if you buy something, you've got the largest potential inventory of people to sell it to somewhere down the road when you want to exit that investment. That's a very important consideration to mitigate your risk. Most capital has been severely affected, most commercial real estate capital has been so severely affected by the downturn that there's sort of this retreating to a very risk-averse posture. And so if you have a quality asset, whatever you'd consider the top quality asset in a primary market, the marketplace is paying a lot of money for that today. Cap rates are very low. They're paying a lot dollar per square foot. The opportunities would probably come if if you're not in the core space, if you're not competing to buy those best quality assets, and you're willing to go out on the risk posture a little bit, is to fund in development opportunities. Now, in what product types does that work? It probably doesn't work in office buildings because there has been some construction in office buildings and the vacancy rates are fairly high on most metropolitan markets. Some markets are bouncing back relatively quickly. But still, the prognosis is for a relatively low growth in those rental rates and a rebound to take some period of time in the office sector. In the multifamily and the apartment sector, there's a lot of demand coming there from the echo boomer, baby boomer sort of populations. And that's probably one of the more attractive sectors to be in. But prices are getting bid up. Returns are down. If you can build into that market, you may miss it by, you may not time it exactly right, but if you choose the right markets, you should do just fine in terms of, as a long-term investor. If you're looking to go in, build, lease it up and sell it, that's a little bit more precarious position. If you've got the luxury of investing over a longer period of time, then you can choose your exit strategy as the markets rebound.